Let's dig into the detail of the multifamily space. We've talked a lot over the years how real estate is about the basics of supply and demand. And, you have to dive into all those demand elements. You have to dive into all the things impacting supply and what's going on there. And then you have to look at the relationship of demand and supply. And then you got to take it and you got to apply that to each local market that we're investing in. So let's dive into it. Billy, why don't you kick us off? Why don't you talk about what's happening overall, the rent growth and vacancy factors?
Real estate, all about supply and demand. You've heard us all say that. The intersection of supply and demand is price. And we measure that here in the form of rent. And the excess supply that we're facing in the marketplace. And what we'll continue on with is how actually steady and healthy demand is. But you can see some instability from 2021 forward. And I think this slide in particular that shows how rents have moved and how vacancy has moved in the last 5 years is very telling. Let's start actually with the dark blue line that finishes to the bottom right here. If you look back at 2021 through 2023, we were in a period with record rent growth over the last 25 years. And that's what resulted in all of that development activity. The developers saw that. Think back to the post-COVID world, many people leaving the coastal markets, chasing the Sun Belt markets, and developers responded in too great of a manner. At that time, when you saw that level of rent growth and some really significant migration flows to the Sun Belt market, and you couple that with record low interest rates and cap rates, it was a formula for every development deal looking beautiful on paper. And you can see the impact of all of those development deals coming to fruition over the next, call it 3 to 4 years. So if you look out to 2024, we hit that was a year of record deliveries in the country with over 600,000 units. If you, again, looking at that dark blue line, you will see flat to ultimately negative rent growth in 2025. And at the same time, you will see increases in vacancy, that light blue line. And you can see we're operating in a pretty stabilized, call it 95%-ish occupancy perspective going into the, call it 2021. 2022, we saw vacancies really get tight along with the rent growth. That's since contracted on occupancies.
So we had a 97% occupancy in 2022. I mean,
97% occupancy and record rent growth. They hit with magnitude of supply.
Low interest rates. So it was a formula that made people go build a bunch.
And while that formula has caused real pain the last couple of years, it's completely flipped on its head. Development costs are up, rents are down, concessions are up, vacancy has increased, and the cost of capital has increased, the cost of debt and the cost of equity. And we believe that will be a critical factor to success in the space over the mid to long term, because we're going to work through this period of excess supply. And I think in the mid to long term, we're going to have a hard time keeping up with the demand.
Let's dive into the details of demand.
Yeah. So looking at the chart of demand, if you look back over the last 25 years, what you will see is very healthy, steady demand growth. And if you take an even narrower lens and viewpoint, look over the last 10 years, you see average household formation of 1.26% per year. Despite all of the headwinds associated with immigration challenges, in 2025, we saw household formation grow just less than 80 basis points per year. The demand story has been very stable and a real tailwind over the last 25 years. I would say we have some current concerns we're closely monitoring. The downward trend on immigration is a concern, but even despite the last year's challenges, to see 80 basis points roughly of household formation growth, if you multiply that by the 135 million households in this country, we need 950,000 apartment units or homes annually. So long story short, the demand picture is intact, has been intact for a long time. And what's creating the household formation growth to exceed the population growth, it's societal trends. If you think back over the past 50, 60 years, the number of people per household has decreased as the number of People per family has decreased. People are getting married later, living longer, living alone longer. All of those are tailwinds for reduced people per household, which is also a tailwind in the multifamily space. So while demand is healthy, we expect it to continue to be healthy. We're monitoring the downtrend closely. It's important to think about where that incremental demand will want to live. And that's a great transition to the next slide, which shows the unaffordability of single family homes. And what we capture here, I think it's interesting to look back about 15 years. In 2012, if you compare median home prices in the country in 2012 versus 2025, they are up 143% versus rents of just 78% in that same time period. And the cost of a home is not the entirety of the cost. You have taxes, insurance, interest. All of those have increased significantly in the past years as well. So what we do on the subsequent chart is we track the average cost of principal, interest, taxes, insurance, and we compare that with the cost of to rent. The combination of home prices being up so dramatically, plus the increase in interest rates in the last 3 to 4 years, we are at all-time highs in terms of the delta between the cost to live in a home versus the cost to rent. With the cost to live in a home being in the range of $3,000 per month and the cost to rent being in the range of $1,860 per month. I think that's going to be a real tailwind for the incremental demand, the 950,000 additional homes we need annually. Seeing the unaffordability of single family, especially considering some of the AI challenges and the impact that may have on employment, wages, et cetera, I think it's reasonable to believe we're going to see an increase in the demand, the share of housing that goes to multifamily versus single family.
Throw some highlight. Historically, multifamily has been roughly about 30% of the
35%.
35% of the new housing stock, and the balance being single family. And what you're suggesting then is that 35% that was multifamily might grow to a higher percentage. Maybe it's 40, maybe it's 45%, maybe it's 50% because of the realities of everything going on.
Yes. And to just quantify that, if you put 40%, I think is a very reasonable assumption looking at the unaffordability of single family housing. 40% of the 950,000 of incremental household formation that we might expect looking at backwards looking data, we're going to need 380,000 new apartments. And not trying to every year. And I'm not trying to steal Dan's punchlines, but we're going to look at the supply charts in a minute, and you're going to see trends based on real start data today, very much inside that need. If you look at just the backwards looking data, apply a 70 basis point growth factor from a household formation perspective on our current households, and multiply that by 40% of that going to multifamily, I think we're going to have a hard time keeping up with the demand needs of our country.
Yeah, and I'd say the demand side has been really healthy. Can be expected to continue to be healthy despite some things happening in the marketplace overall. And so now it's flipped to the other side of the economic equation, which is supply. So Dan, let's dive into supply. Let's talk about starts and permits and deliveries, and why don't you dive into it and walk us through this?
Yeah, happy to take it there. And I mean, before I do, Billy, you left out one stat on just the average, first time home buyer.
Yeah.
And what's happened just in the last 5 years. Today, we just hit the average first time home buyer age, hit 40 years old. 5 years ago it was 30, low 30s. So we've seen a drastic movement, and it's just another stat that we're seeing it in the single family data.
That's a huge change.
It's a huge change, and people are having to rent, and they're renting for longer.
Yeah.
So on the supply side, we've hit it, and we're going to hit it some more. We saw record deliveries, 40-year high, over 600,000 units. I've said it a few times, and that happened in 2024. So why 2024? Let's think about construction cycle a little bit. Low interest rates, booming rents, tight occupancies. People started permitting, right? We saw permits spike, and people put shovels in the ground in a big way. And that started happening in 2021, 2022. And then it continued to go on for, through 2023. But it takes roughly 18 months to, build an apartment project, right? From the time you put a shovel in the ground to the time you finish leasing it up. So, right, add your 18 to 24 months on from 2021 and 2022. And there you go. 2 years later in 2024, we saw record deliveries. But the trend is trending down, right? And we're happy to see that trend going that direction. 2025 last year, we saw somewhere in the range of 400 to 500,000 units delivered. 2026, we're expecting somewhere in the range of 300 to 400,000. And then in 2027, when we're looking out and beyond, we're going to be below the long-term trend of roughly 300 to 350,000 units delivered that we saw over the last 20 years. So just to say that again, we've seen 300 to 350,000 units over a long period of time that's been delivered on an annual basis. We're trending to deliver below that number in just a few years' time. So it's a huge shift.
And we have some data for CoStar, don't we? That gives a little bit of what they project the deliveries are going to fall to in the years ahead.
It's probably a good way to transition to talking about starts. New construction starts are falling down to roughly the 50,000 a quarter range. And if that trend continues, 50,000 annualized per quarter is roughly 200,000 units being delivered.
But didn't Billy just say we need 380,000 units per year?
I believe he did. So
As I did.
I'm not a math guy, but if I was a math guy, I think we'd have a shortage of housing and just a figure ass savvy. Yeah. So no, clearly the trend is favorable for multifamily operating performance, right? And we're going to talk about what that means from an occupancy and a rent growth and a concession burn-off perspective.
And I just emphasize that's why we're encouraged that the current excess supply that's been delivered to the marketplace, we've had incredible actually demand absorbing a lot of that. We're really encouraged about what we see ahead because of that demand side for multifamily and the great slowdown of new product due to the cost of construction, interest rates, and all that kind of good stuff. It's encouraging what's ahead for us as far as the multifamily market healing from this period of excess supply.
Absolutely.
It reminds me a lot, go back and show my age, but in the early 90s, we saw starts, it was similar to the mid 80s. They built all kinds of stuff for income tax reasons, and they were building like 600,000 units a year back then. And then from 90 to like 94, 95, they were only delivering like 100 to 200,000 units per year for like 4 or 5 years. And, I have good chance we might be looking at that again going forward here. Obviously, we don't know. But certainly the math says that the wind's more on our back and recovery's ahead.
And I thought, should hit on the math. Some people out there might be saying, well, just build more multifamily housing units. If you're seeing a shortage, why don't we just build them? And being a math guy, the answer is the math doesn't work, right? The math is very challenging. So if you're a developer and you have to raise equity from investors to invest in your new development, you have to raise debt. It demands, right, a certain return on the capital and a certain return on cost. The numbers needed and the return on costs needed, you just can't get there with where rents need to be, higher costs to build that have not been going down, right? They've been going up and to the right and continue to increase from a physical cost perspective, labor costs, land costs, et cetera. And the only way that most developers or many developers are getting deals done today is they need some sort of incentive from local municipalities, oftentimes through tax incentives to make those numbers work. And municipalities only have so much revenue or tax incentive that they can give out. But that's really the numbers just don't work to build new construction today.
Yeah, any kind of scale. And there's going to always be sub-markets where it makes sense, but in any kind of scale. Other information you want to share about the market there?
So I talked earlier about, we track really closely permits, right? So when a developer goes to build a new project, they have to get it entitled and permitted by the local municipality. When you look at our permit chart, You kind of see an uptick in permits recently, which we're continuing to watch and monitor. But it's very important to note that not all permits turn into starts, right? So you might get a project permitted, but it doesn't mean you raise the equity, you get the debt, and you actually put shovels in the ground. So even if you look back at, the stats here, when we say that we had 50,000 units started in the last quarter, the permits were actually almost double that, at like 100,000 permits in that quarter. So it just shows you that, right, it doesn't line up exactly. Not all permits turn into starts. So it's an important piece that we watch.
Anything you want to mention about geographies in the story?
Yeah, 75% of this new supply has been very concentrated in the Sun Belt and Mountain West markets. It's, developers very much focus on population growth and job growth, and there's been a ton of that in those markets, and developers have followed that path. Whenever you drop a lot of supply on one area, think about your local neighborhood here, or wherever you are. If you dropped 5 multifamily deals across the street from each other, even if you really needed all of that supply in that area, right? You had all the job growth, the population growth to absorb it. Having that many projects in one submarket, it doesn't go well in the near term, right? Developers have different incentives to lease up their properties, right? They have construction debt that they're trying to repay and, return capital. Maybe they're a merchant developer where they want to just build and sell and they move on to their next project. So what happens is, operators have varying levels of focus or desire to lease up quicker, and they give, lower rents perhaps. They give concessions or free rent, sometimes 1 month, sometimes 2, maybe 3. And what that does to other, projects in the area can be, really damaging. And it takes time to grow out of that. So you talked about it's not a V recovery. And, when you think about submarket by submarket where supply is, and that's really the important piece, right? When we're analyzing opportunities to acquire, is you have to be dialed in at the submarket level and understanding, right, how that certain submarket is going to handle the existing supply or potential new supply.
So how has that impacted lease rates, for example, when you have that condition?
Just before I hit on lease rates, Dan's maps, I'm going to get back to our map man over here. We have a map of every market we chase. Google Map, within that Google Map, we drop pins every time we look at a property, underwrite a property, tour a property. We collect and aggregate great data on it. So the granular detail that we go through before each investment decision is made to evaluate the risk of new supply has never been greater. And we are so focused on that new supply risk on a micro basis because the new development in North Dallas, they have no impact or will have no impact to the rental market here in Brookfield, Wisconsin, where we're sitting today. And the bifurcation between the markets is significant. So if you look at the chart here, you can see the magnitude of new supply that's come in the Sun Belt. So our portfolio that we own or have ownership interest in, excluding what we third-party manage, is about 33,000 apartment units. We have great real-time, day-by-day data on the portfolio that our affiliates manage. And we rely on some third parties and some joint venture sponsors to source deals and manage assets in markets where we don't have the depth of talent to be the best-in-class manager. But our data and the investment we've made into tracking our portfolio is significant. And I can tell you, and it's fun to see the real page data. It's presented here. And it's fun to compare that and think about that as it relates to our portfolio to better identify new opportunities, make better investment decisions. And what we can show here is the South having this level of new supply that's shown between 23 and 25. Our portfolio in the Sun Belt today that our affiliates manage is 91% occupied, and new leases, the headwinds of this supply has resulted in not only flat to declining rents, but concessions too, often in the form of 1 month free. And when you add in the rental increase or decrease plus the concession, new leases in our Sunbelt portfolio are down 5.4%. This is data over the last 30 days. Renewals And in the Sun Belt, we're averaging renewal rates at about 60%. Renewal rent increases are up 2.3%. So our priority, what we are working very hard to do on an asset by asset basis, is renew as many tenants as we can to elevate the tenant experience, to save any tenant that may state that they're moving to a new apartment complex to get that 1 month free. Our team is laser focused to save those tenants, renew more. You don't have the vacancy, and often you can get a modest increase. The reduction of rents on new rents of just over 5%, it's likely actually a nominal rent increase, but 1 month free of concession to start. And when we burn that off at the end of the lease term, if the market has worked through the entirety of the supply, let's say in 2027, we'd be in a position where just a 3% rent increase with no new concession would be pretty material.
As the market recovers, as the new demand comes and supply starts slow, you're going to see those occupancies go up. We're going to be more likely to charge higher rents and not have concessions, and revenue will be up.
Absolutely.
Highly likely.
We have a lot of conviction in that. And I am going to compare the Sun Belt with the often overlooked Midwest. We are 3 people that were grateful to raise our families here in Milwaukee, Wisconsin, and it is a great place to live. And let me tell you, nobody lives here because of the weather. We are here because of the great people. And right now, our less exciting from a demand and population growth markets like Milwaukee, they are the darling. If you look back the last 30 days in our portfolio, our multifamily in the Midwest, this includes some Northern Illinois, some Minnesota properties as well, we are 95% occupied. Our new leases, and this is over 120 new leases over the last 30 days, we are up over 8% and our renewals are up over 4%. So yes, the Sun Belt is experiencing some softness today. If you look at this chart, you see the dramatic impact that new supply has had when I tell you about the declining occupancy, concessions that we're forced to offer. But you compare that to the Midwest, which is shown here in the light blue line, and not dramatic supply increases, not dramatic household formation either. And we are showing some really attractive rent growth. And we get in there and we do the heavy value add that we're doing across many of these properties.
Yeah, and that's the beauty of a diversified fund, right? So we have the Midwest assets and some other assets in the same fund. And, you love to be a market timer and just buy the stuff that's going to go well always, but we don't always know the future. And so it's the beauty of having a diversified fund for our clients and reducing risk in real estate investing.
It's critical. And if we were talking 3 years ago, we would have been saying, maybe 4 years ago, we would have been telling you that the Sun Belt is the darling because it had the level of people migrating to Sun Belt markets. Think how many people left California, New York, et cetera, made stops in Phoenix, Dallas, Florida, different Florida markets, et cetera. We were capturing that. And the Midwest wasn't as exciting at that time. That story's flipped. I think there's a good chance another 3 to 5 years out, that story may flip again or just rebalance. So you're going to see more balance between the two. So diversification, as we shared before, it's timeless. We deliver that in all our fund structures.
That's great. I think it'd be good to hit a little bit on the long-term picture, Dan, on cost construction, what has happened over the long haul, and kind of compare that to what's happening with rents overall. I think it's a good analogy to look at.
Yeah. And I hit a little bit earlier on just, how challenging it is to build. And this obviously is the cost to build is a big portion of the math, right? You need the costs, you need the rents, and investors demand a certain return on their capital to build new projects. But the data really shows, since 2000, construction costs on average have increased over 3.7% a year. And at the same time, rent growth has been closer to 3% per year.
And you can't build new stuff if the rents don't justify the cost of new construction. And so this is part of the reason why new construction is so challenging, is because rents haven't kept up with the cost of new construction.
Right. People often need incentives to make the numbers work. They just can't make it, without getting often tax incentives to get the appropriate returns.
Anything from Billy or Dan, from a demand perspective or impact to revenue, with wage growth versus rent growth? Anything we're seeing on the wage side?
If we look at it on a national level, right, rents have been pretty flat. Again, we just talked a lot about digging into, submarkets or regions and the differences there in rent growth. But in the Class A and B space where we really focus, you've seen rents come down because there's been so much new supply, right? So this new supply inherently vacancies have gone up a little bit, and at the national level, rent growth has flattened, around 0%. So at the same time, you've actually seen wage growth, right? In kind of the tenant and resident that we target, rents have flattened. At the same time, their wages have actually continued to increase. So wage growth has increased well above their rent growth. And it's actually, we look at the percent of income that people or residents pay towards rent compared to their income, right? And a healthy ratio is always somewhere below 30%. We've seen kind of in our tenant demographic, that's usually in the low to mid 20% range. It's actually gone down a couple of points, again, because rents have gone down, wages have continued to grow.
So big picture, as a real estate investor, that tells you that there's likely room for people to pay more in rent because they've had wage growth. So once we do get the market recovery likely, and occupancies tighten, and now the ability to move rents may be real because people have the wage growth to offset and pay that at certain levels. Obviously, the workforce housing tenant that got hurt by inflation probably I know they're still hurt. But if we're really talking the Class B, Class A assets, that higher wage growth could mean higher rents for us down the road.
Yeah, and we refer to it as the renter by choice, or the upper level rent by necessity kind of sector of resident.
Dan, you want to pull together a little bit the overall picture for multifamily and kind of bring it home?
Sure. We hit on supply, we hit on demand, we hit on capital markets. We talked a lot about the differences regionally, right, between the high supply areas and the Sun Belt and the Mountain West, and the low supply areas of coastal regions or the Midwest. But we very much believe that there's going to be, we refer to it as a snapback coming. And we don't know if that's tomorrow, next year, 2 years. It depends on the submarket and the amount of supply and the supply-demand balance in each of those areas. But it's coming, and it's going to happen. And it's going to happen market by market, submarket by submarket. So again, what that means, right? Rent growth, no concessions, or reduced concessions, and higher occupancies. And it usually happens in a little bit different order, right? First you get occupancy, then you burn off concessions, then you get rent growth. But we think that's a great environment to buy in. We're excited to, place bets into those areas, while at the same time we're continuing to focus on steady, stable income in places where we're seeing continued rent growth and tight occupancies. So it speaks to our diversified approach and why we continue to, look across the country for opportunities. From a competition perspective, we talked about equity, and the conversation of beating the herd a few years ago. There's still a level of that, right? Not all equity capital is back investing in private real estate, but we really feel it's a matter of time before there's a lot more equity that's looking, and specifically into multifamily and industrial, because those are arguably the two most demanded, sectors of private real estate right now.
I'd just add the equation for value in multifamily real estate, or all real estate, is very simple. It's operating income divided by a cap rate. We've stated it before and in different ways. Operating income soft because of excess supply. We have a lot of conviction it's going to rebalance. It's going to harden, allow for some growth for our investors, some attractive returns. Values are soft because equity is in very large part on the sidelines. I'm going to be a little more bullish than Dan and say last year, across the largest non-traded REITs in the marketplace, we still saw net redemptions. There was more capital looking to exit those vehicles versus enter. And because of that, I'm confident we're going to see the pendulum swing back in the favor of private real estate in the future. In both pieces of our simple value formula, I think will improve in the coming years. And that's not betting on any interest rate relief or speculating that interest rates will come down. That is looking at the data as it relates to equity inflows and looking at the hard data as it relates to supply and demand.
Billy, Dan, thanks for all the effort and putting all this information together to educate our viewing audience here. It's fun doing it. I get fired up seeing the numbers, and it gets me excited about investing more myself. So any other comments, Billy or Dan?
I just say so grateful for those who've entrusted their capital with us. We work hard to protect and grow that every day. We are passionate about what we do. We dig into the macro to the micro. We're eager to share what we do with you. And thank you again for listening today for your investments with us.